Hi, this is a tax resident, and today we're talking about a topic that's important for anyone involved in international business or planning to benefit from tax treaties: the Tax Residency Certificate. We'll break down what it is, why you need it, when to get it, and how to apply for it. So let's get started. So, what exactly is a tax residency certificate? Simply put, it's an official document issued by the tax authorities of country that confirms your or your business tax residency in that country for a particular tax year. There are a few key reasons why do you need a tax residency certificate. Avoid double taxation. With a TRS, you can prove to the tax authorities of a foreign country that you are tax resident in your home country. This allows you to claim benefits under a double taxation avoidance agreements and avoid being taxed twice on the same income. Reduce tax rates. To reduce the tax on dividends from 30 to 10% using a tax resident certificate, you need to benefit from a double tax treaty between two countries. Many countries have such treaties to prevent double taxation and reduce withholding tax rates on dividends, typically in the 10–15% range. Here are a few common examples where TRC can lower the dividend withholding tax to 10%. The US has tax treaties with several countries where the withholding tax on dividends can be reduced to 10%, such as with India, Switzerland, and the Netherlands. Under India's tax treaties with countries like Germany, Singapore, and France, the dividend withholding tax can drop from 30 to 10%. The UK has treaties with countries like South Africa, Italy, and Israel, allowing dividend withholding tax to drop to 10%, with a valid TRC. In some cases, a TRC can even qualify you for complete tax exemptions on certain types of income. A tax residency certificate serves multiple purposes beyond just obtaining reduced tax rates on dividends through double tax treaties. It's also crucial for verifying your tax residency to third parties, such as banks. Financial institutions may require a TRC to confirm your tax residency status for regulatory compliance, particularly for reporting under international tax rules like FATCA or CRS. This helps banks ensure that they're applying the correct tax rates and following proper reporting obligations. Business partners, counterparties. A TRC may be required by counterparties to confirm your residency status, ensuring they withhold and report taxes correctly in cross-border transactions. It helps prevent incorrect tax treatment or unnecessary withholding. Platforms: Facebook, Google, and other online platforms. If you are receiving payments from global platforms like Facebook or Google, they may request a TRC to apply the appropriate withholding tax rates based on the tax treaty between your country of residence and the country where the platform is based. This ensures you are taxed according to the treaty, often resulting in reduced withholding tax on income like royalties or ad revenue. When should you get a tax residency certificate? Timing is a key here. You should apply for a TRC at the beginning of the tax year or as soon as you anticipate receiving income from a foreign country. How to apply for a tax residency certificate? The process can vary depending on your country, but generally here's the steps. Submit an application. Start by filling out the required application form from your local tax authority. This might be available online or at a tax office. Provide supporting documents. You'll need to provide evidence of your tax residency. This might include your tax returns, proof of permanent residence, or a letter from your employer. Pay any fees. Some countries charge a small fee for processing the TRC application. Make sure you check if there are any costs involved. Wait for approval. After submitting your application, it might take time for your TRC to be issued. Once approved, the certificate is usually valid for the entire tax year. Real-world examples and case studies. John, a software developer based in the UK, receives freelance payments from clients in Germany. Without a TRC, he faces a 25% withholding tax in Germany. However, after providing a TRC, he is eligible for a reduced tax rate of 5% under the UK-Germany tax treaty. Case 2. A company headquartered in India received dividends from a subsidiary in the United States. The company can reduce the US withholding tax from 30 to 15%, significantly boosting their after-tax earnings. Before we wrap up, here are some common challenges people face when applying for a Tier C, and a few tips to help you out. Delays in processing. Sometimes tax authorities may take longer than expected to issue the certificate. To avoid this, apply early and control the process. Sometimes it's required to remind about yourself. Documentation issues. Missing or incorrect documents can lead to rejection. Double-check your application, make sure all your documents are in order and provide detailed evidence of your tax residency. Understanding tax treaties. Not all treaties are the same. Make sure you fully understand the provisions of the relevant tax treaty to maximize your benefits. If you found this video helpful, don't forget to give it a thumbs up, share it with others who might benefit, and subscribe to our channel for more financial tips and guides. Stay informed with Tax Resident. Download our app Tax Resident and be safe and under control of your tax residency.